Welcome to the Investment Management Service May update. So May was a strong month for markets, and we've got John here to give us an update on what went on under the bonnet. So over to you, John.
Yeah, it was a strong month of returns in the equity market led by the US, which reversed quite a lot of its post-Liberation Day weakness. A number of factors really supportive of the equity markets. We had some strong corporate earnings data for the first quarter. A lot of that reflects front-loading of activity ahead of the imposition of tariffs, but nonetheless pretty positive against expectations. We had a pause in the reciprocal tariffs between the US and China. Again, that was supportive. And then finally, we had the passage through the House of Representatives of what Trump has called his One Big Beautiful Bill Act, which would further roll over existing tax cuts and ultimately prove to be quite reflationary as far as the US economy is concerned.
Yeah, so there was particular strength in the US equity markets. However, when you translated that back to sterling, it was slightly less impressive. Year to date, the underweight position to US equities that we have in the funds has been a tailwind performance, but obviously over the last month, less so. As we look forward, we still think an underweight to US equities is appropriate. We still think there's some risk in terms of equity valuations, but also I think we still see some risk in terms of the currency. There's obviously a lot going on there. So what's your kind of thoughts in terms of the dollar and currency risks out there?
Yeah, twin deficits, both in terms of the fiscal deficit and also the trade deficit, tend to find their most rapid expression via currency weakness. And that's one of the key drivers of the dollar underperforming, and we think that will continue. So I think for US equity investment, a weak dollar will be a headwind to performance.
Yeah, and I think the other thing that we're seeing is obviously with the significant deficits, there's also risk in the bond market there. So the way that we're kind of expressing that concern is with a shorter maturity bond that we're lending out to governments at the moment. And I think that's kind of how we're trying to protect the portfolio from that. But it also offers some protection from some of the geopolitical risks that we're seeing out there. So there's a lot going on in the news that we're all reading about and we're seeing about. So I just kind of wondered your thoughts on the geopolitical risks out there and what we're seeing and hearing.
Yeah, so geopolitical risks will manifest themselves in investors focusing on short-dated bonds. But also those geopolitical risks could arguably be a bit negative for very long-dated bonds. That's why we tend to favour shorter maturities. But I think, the general outlook in terms of markets has to be supported by this view of policy reflation. So although lots of, electorates around the world are very angry and they feel that they're being left out in terms of being beneficiaries of the growth dynamic, nonetheless, policy reflation via boosting nominal GDP, stimulating the economy via fiscal support, with also some monetary policy stimulation, will ultimately be a tailwind, I think, to risk assets and particularly equities. And we do expect to see a continuation of what's been quite a strong equity market as we go through the balance of the year into next year.
Yeah, that's really helpful, John. So short term, I think still quite a lot of volatility out there, but as we look 12 to 18 months out, I think there's lots of opportunities still in the market.